Ever pondered the secret language of options trading? Why are Greek letters like delta, gamma, theta, and vega tossed around in the financial world? Well, traders use these Greeks to gauge shifts in options pricing. Let's decipher this cryptic language together, shall we? First up, we have delta. Think of delta as a measure of sensitivity. It shows how much an option's price might change with a $1 movement in the underlying stock's price. If a call option has a delta of 0.5, for example, the option's price will rise by 50 cents for every dollar the stock price increases. Conversely, the price will drop by 50 cents for every dollar the stock price decreases. Delta provides an estimate of the probability that an option will end up in the money at expiration, making it a vital tool for traders. Next, meet gamma. Gamma is essentially the speedometer for delta. It measures how fast delta changes with a $1 movement in the underlying stock's price. If delta is the sensitivity of the option price to the stock price, then gamma is the sensitivity of the delta to the stock price. In other words, gamma provides a measure of the acceleration of the option's price. A high gamma means the option's price is likely to change rapidly, which can be risky, but also presents opportunities for traders. Then there's theta, the timekeeper. Theta measures the rate of decline in the value of an option due to the passage of time, also known as time decay. If all other factors remain constant, an option will lose value as its expiration date approaches. This is because the probability of the option being profitable, or in the money, decreases as time runs out. Theta is particularly important for traders who employ time-sensitive strategies. Let's not forget vega, the volatility vulture. Vega measures the sensitivity of an option's price to changes in volatility. If the market becomes more volatile, vega indicates how much the price of the option will change. Traders use vega to understand how a change in implied volatility will impact their options positions. Finally, we have implied volatility. It's not a Greek, but it's just as crucial. Implied volatility is a measure of the market's forecast of a likely movement in a security's price. Higher implied volatility means that the market expects the stock to make big moves, which increases the option's price. Traders use implied volatility to price options and to gauge whether an option is overpriced or underpriced. In summary, the Greeks and implied volatility are essential tools for options traders. Delta shows how much an option's price will change with a movement in the stock price. Gamma measures the rate of change in delta. Theta tells us how time decay affects the option's price. Vega measures the effect of volatility on the option's price. And implied volatility gives us a sense of the market's expectations for a security's price movement. Understanding these concepts will give you a significant edge in the world of options trading. So keep these Greeks in your trading toolkit and use them wisely.
So let's quickly look at the Greeks of options in Thinkorswim. Here we have delta, gamma, theta, vega. I want to keep in mind that we like to say theta decay is real. So when we're holding 0 DTE options contracts, a matter of minutes holding through consolidation could actually cause you to lose value in your contract. So this is one of the things that makes options trading very tricky, is oftentimes, especially with 0 DTEs, you're trying to catch fast moves and you don't have a lot of time to continue to hold that contract because it could lose value to that theta. Sometimes when there's spikes in volatility, the value of the contract can spike up real fast or it can spike down real fast. It's another dangerous thing. But this is why for volatility we pay close attention to news events, etc., because that can really cause quick and sudden changes.